Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Wednesday morning. We are coming to you live as always from the CNBC-TV18 News studios. I'm Prashant. With me, my colleague Surabhi and Nigel. And guys, good morning. It's always something new, isn't it?
It's always something new. And yes, there is some red on the Asian screens. But Prashant, spirits, at least my spirits, start soaring high. It's Wednesday. We made it to the middle of the week. And, it just gets better from here on, I think.
Hey, let's hope it does get better.
Absolutely. People must be wondering, what are these guys talking about, right? I mean,
they probably know us by now.
Well, we're talking about the new thing which has happened post-US market close last night, which is the fact that one of the three large rating agencies in the US has downgraded US's sovereign rating. Sovereign credit rating has been downgraded by Fitch. The other two, of course, are S&P and Moody's. So the rating has been moved one notch lower from AAA plus, from AAA to AA plus. So it's a one-notch downgrade. Fitch has basically cited fiscal deterioration, the standoff on the debt ceiling, etc., etc. I mean, the general kind of complaints with the U.S. debt levels and the completely dysfunctional political situation out there. So these fiscal cliffs and standoffs, etc., have been discussed quite a bit. The last downgrade to the U.S. sovereign rating was by S&P. That was back in 2011. Market reaction, by the way, so far, if you look at U.S. rates, you look at, which is fixed income, you look at Forex, the dollar, or you look at equities, right? I mean, all of it has been mild. Remember, all of this came through post-U.S. markets. I just want to kind of halt there 1 second and make 2 or 3 points. If you're wondering, and this sounds like a big headline, right? The largest economy by far in the world getting downgraded by one of the 3 big rating agencies certainly has shock value. But I would argue and say that the shock value this time around is not as large as it was back in 2011. 2011, I remember, I think, it was a Saturday for us. And it was out of the blue. It was a jolt to the system. And for some time, there was a bit of risk aversion, which we had seen. This time, because of what happened in 2011, there is a precedent. And, it's kind of well understood. That is point number 1. Point number 2, if you're interested in knowing what is the impact on markets, go back to the 2011 experience. What happened? I mean, a rating downgrade basically means that borrowing costs go up, which means yields go up. After 2011, S&P's downgrade of the U.S. sovereign rating, the opposite happened. Yields actually went down. Bonds went up. The reason is very simple. Despite the rating downgrade, there was risk aversion. What happens in risk aversion? People go to the safest instrument that they know, and that still remains the U.S. Treasury. U.S. government bond is the safest instrument in the world, despite the fact that the rating for the U.S. got downgraded. So that is the experience from 2011, and that is the most simple, direct channel through which equity markets, etc., get impacted. So, I mean, this time around, we can go into other details, etc. But the point is this, that the impact, perhaps, it's more well understood. There is a precedent. And like what we saw in 2011, I mean, it doesn't have to work like how they say it in textbooks. The U.S. Still enjoys extraordinary, exorbitant privilege, right? I mean, U.S. exceptionalism. And that's the reason why, despite downgrades, etc., things have not really moved that much. So that's, a quick bit as far as the U.S. Action is concerned. Now, overnight, even before the Fitch rating downgrade came through, for the U.S. market, you had the 10-year, which has topped 4%. You've got the dollar, which is now above the 102 level. Both these, at the margin, are negative. They're not positive for emerging markets. Equities closed lower. The S&P was down about 0.25%. The Nasdaq was down about 0.4% as well. Now, to put all of this into levels in terms of how to trade the market from here, the Nifty is closed just below the 19,790 level, which is the touch point on a falling trend line. From the recent high, there is a trend line which is falling. So these levels will also keep coming lower. But we left off just under 19,790. The close was 19,733. So that becomes the first resistance on the way up to take out this falling trend line. Supports come in at the 20-day moving average, which comes in at 19,616. That is right under where the Nifty is closed. For the Bank Nifty, again, we're sitting just above the support, which is 45,408, and we are not very far away. We closed around 45,600. That's the level to be defended for the Nifty Bank. And once we do that, I mean, maybe we'll look at the high levels once again. Let's have the GIFT Nifty up on the screen. The fact is, and we said this yesterday as well, the trend still remains up. That's not been damaged, but some consolidation, a quiet day like yesterday once again. I think I would take it with both hands without any complaints whatsoever. Surabhi.
Prashant, hi. The Fitch statement definitely made for an interesting copy, right? Because they went on to say, and I'm just quoting from the text, in Fitch's view, there has been steady deterioration in standards of governance over the last 20 years. So they were citing that brinksmanship that was going on the debt ceiling, and that happens. We always talk about it, like year on year. It's the same sort of back and forth that goes on, and I guess that kind of triggered this ratings action from Fitch. So there is global risk-off. That is how we're starting off the morning. Asian markets can't ignore this development. So largely speaking, there is a lot of red across Asia. I'm looking at most markets now. The Japanese market, interestingly, is falling the most as we speak. It's down about 1.8%. Hong Kong's down. Mainland China is down. Kospi, all of your Asian markets are lower this morning. That's one. Of course, the interesting aspect of this is that U.S. Treasuries are actually, the yields are actually moving higher, as Prashant has already explained. So 4% on the 10-year. The gap between the 2-year yield and the 10-year yield is actually widening a little more. So the spread is also widening. We need to watch out for that. The dollar, for what it's worth, has kind of climbed down a little bit. The yen strengthened versus the dollar in reaction in Asian trade this morning. So the dollar index, now it's gone back to 102. About half an hour back, it was at 101.8. So need to watch out for how these parameters move as we go along. But in addition, I just want to point out, if you're looking for more negative news on the macros, there's plenty. There's PMI numbers from around the world that are looking pretty disappointing. China, Eurozone, and the US. So from China, we have the Caixin manufacturing PMI number, which has fallen into a contraction zone, 49.20. From the Eurozone, we have this HCOB, Eurozone manufacturing PMI, which actually is at the lowest level since May of 2020. It's deep in contraction, 42.7. And then there is the US ISM manufacturing number, which is also in contraction, 46.4. It was slightly lower than estimates, but it was still better than the previous print. The June print was 46, July is 46.4, so minor improvement for what it's worth. So anyway, short point, macros are not supportive this morning. We come to our cues and look at the flows picture, and here the last couple of days have been very iffy from the FPI perspective. That continued yesterday as well. There is a mild net sell. It's not a big sell figure, but a small one, 92 crores. Domestic institutions are still continuing their buying. DI is up about 1,000 odd crores. By the way, there's an interesting mid-season note from Motilal Oswal. I just thought I'll put out the highlights on Nifty earnings so far. 33 companies have reported on the Nifty. Motilal says that 43% have shown the profit growth is 43% versus their estimates of 41%. So that's the good part of it. Out of the 33 companies that have reported so far, beats in 12. 12 have been in line, so neck to neck, and 9 have been below their estimates. What this is telling us is a point that we've been repeatedly making here, that there is nothing in this earnings season that is supporting further upgrades or multiple expansions. And that's something that the bulls will have to keep in mind as they go forward. Talking about the levels, yesterday's low is 19,704, so that's going to be in focus. And of course, the 20 DMA, which is at 19,616. Today's earnings calendar, just to kind of, wrap things up. Titan is the big one. There's HPCL. There's, of course, Ambuja that we'll watch out for. And some interesting mid-cap names like Gujarat Gas and Godrej Properties as well. But Nigel, I guess this is going to be a challenging start for the bulls. The setup, they've got everything going against them that is possible. So how are you looking at the cues?
Well, that's right. You have the Fitch downgrade that you spoke about. You have a stronger dollar and you have higher crude prices. So the global cues are a little bit muddled, I would say. And that's the point I made yesterday as well, barring that, the new piece is this Fitch downgrade that's come about. But you can't have crude at, $86 per barrel. The dollar index yesterday was at around 102.3 odd, and yet the market moves up. So I think that's making, the bears out here feel a little bit good, and the bulls are getting a little bit nervous looking at both those two data points. Now, the cash market, the FIs, they sold for the fourth straight session. Yes, it was only around 100 crores odd, but we haven't seen 4 straight sessions all the way since 25th of April. So the FIs, they have, taken their leg off a little bit from the accelerator. Let's hope that it doesn't turn into big sell numbers because, if no flows is okay, but big sell flows, that worries us a little bit. How are they positioned in the F&O market, particularly on index futures? They remain net long, but mildly so. Only 51% of their positions are on the long side. I was looking at the options data, the 19,800 call. Now, yesterday, that was getting written very, very aggressively. Close to around 50 lakh shares getting added out there. The premium out there on average was close to around 50 rupees. And if you're looking at the 19,800 mark, it's very important because you look at the open interest on the call as well as on the put side. Now, on the call side, you have 1.36 crore shares. On the put side, you have only 39 lakh shares. The call writers are feeling very, very confident. The bears are feeling very, very confident. And that's why the difference between both those two, it's the same strike, 19,800. it's close to around 1 crore shares on. And I'm not looking at the overall PCR, just look at the PCR for this particular strike. It's at around 0.3 odd. That basically is telling you the bears, well, they believe that this 19,850 odd mark will hold out, going by the options data. So let's get straight to the data points then. Yes, the global Q is a little bit muddled, but I think you'll have to fancy your chances. If you get the market at around this 19,550 to around 19,600, which is closer to around the 20 DMA, you'll have to take a bit of a punt and look to get in, maybe keep a 50-point stop loss at around 19,500 on. But that is the zone from where we are bounced, so that becomes a crucial entry point as well. On the upside, 19,850, as I mentioned. The Nifty Bank is going to be very important today, because given that the Nifty is likely to start on the back foot, the Nifty Bank could start below the 20 DMA. On a closing basis, you want to see that level hold out. So the short point is 19,550, 19,600. Risk reward has been in favor of the bulls. If you get the Nifty around those levels, I think you need to go in and fancy your chances.
Okay, well, that becomes then perhaps a trade that you can consider. But you need to get down to that level.
Yes.
You need to get that kind of gap down. That's what at least the long traders will hope for. Okay, let's kick things off then with the equity call of the morning. Gautam Dugar of Motilal Oswal Financial Services says Q1 FY24 corporate earnings so far have been in line. He says the spread of earnings has been decent, with 65% of their coverage universe either meeting or exceeding profit expectations. However, he adds growth has been led only by BFSI, auto, while oil and gas sector reported 2.6 times surge in profits year on year. They largely maintain their sectoral allocations and weights and continue to rely on the sector winners, with growth visibility driving their stock selection framework. Gautam says that Motilal Oswal remains overweight on financials, consumption and automobiles. They're underweight on metals, energy and utilities. They're neutral on healthcare and telecom in the model portfolio.
Well, let's get you some money market views. Kunal Sadani of Shinhan Bank says that the US ISM manufacturing PMI accelerated in July but was lower than expected. He says the euro bounced back on news of US credit rating cut, and all eyes now remain on the US ADP and non-farm payroll data. Kunal says the dollar index may find resistance at 102.6 levels. For the USD INR, he says 82.2 to a dollar acts as support, while 82.55 to a dollar is the resistance.
On bonds, Neeraj Gambhir of Axis Bank says the 10-year benchmark bond yield traded in a band of 7.08 to 7.18%. He says bond yields spiked on the back of weak auction demand and hardening global yields. The Fed and ECB hiked policy rates by 25 basis points as per market expectations, but the Bank of Japan surprised by tweaking its bond yield control policy. He expects the 10-year benchmark bond yield in India to trade in a range of 7.1 to 7.2 ahead of the MPC next week.
Well, we have a lot of stock-specific action track for you. We're going to be getting to that in just a bit from now in our special Top 10 segment. Let's run you through the list, though. Thermax, Bikaji Food, Sincera Engineering, Sterling and Wilson. They are stocks that could be reacting to positive news flow. But on the flip side, you have more number of stocks that could be reacting to negative news flow. Cholamandalam Investment, Metro Brands, Reddington, Syrma, SGS Tech, and Sula Vineyards. Well, we have other stocks as well that could be reacting. Some of them came up yesterday, some of them reported.
Okay, Gary Schlossberg is global strategist at Wells Fargo Investment Institute. Gary, great to have you with us here on the program. Thanks very much. Will this Fitch downgrade make any difference at all? Or you think it's well understood there is a precedent and the shock value is not as high? What's your sense?
Well, I think the market, as evidence today, looks through that downgrade to the extent there is any concern in the market. The dollar, the U.S. bond market tend to benefit from that safe haven trade. That was true in 2011. To a lesser extent, it may be true this time as well. There may be some technical issues. Some of the covenants in U.S. money funds and bond funds do require a AAA rating for holdings in some of their portfolios. But we don't see that being a major issue. There may be a bit of turbulence, but I think it's really going to be the fundamentals out there that drive the market, the outlook for inflation, economic growth, and the like.
Mm-hmm. So let's talk about the fundamentals, Gary. Sometimes markets use these things as an excuse to start lightening positions, right? Now, would the fundamentals support that view? When you look at, for instance, I was looking at the ISM numbers this morning. They're still in contraction zone, though the GDP number was pretty robust. What do you make of all things put together of the way the U.S. economy is shaping up right now?
Well, I think the rally was easily explained. A very optimistic view on inflation, on economic growth, the implications for monetary policy, the Fed moving to the sidelines. Our view is that economic growth is winding down, but that sharp drop in inflation that we saw in the first half of the year may be losing a little momentum. Inflation may be moving, leveling out at a rate well above the Fed's 2% target rate. That could cause some concern in the market, as well as the less optimistic view of Fed policy. We could see another 1 or 2 rate hikes before the year is out, even as the economy winds down. The environment spinning a bit, turning in the other direction away from the bond market.
Hi, Gary. Good morning. Then what would the call be on
Morning.
global equities? It's been a good 2023 so far. Developed markets, emerging markets, it was getting a little bit too easy. Do you think a good some amount of consolidation, maybe a bit of a pullback for global markets would be warranted?
Well, I think you might see some consolidation. We may already be beginning to see the early signs of that. Again, our view is that the economy will lose momentum, the trajectory a bit flatter than we anticipated, but we still think there will be a slowdown, growth slowdown, perhaps even a recession around the turn of the year as the market begins to focus on that weakening activity. We think that could create something of a headwind for the market. And as I said, with inflation perhaps leveling out at a rate well above the Fed's target level, yields could move up a bit, rates could move up a bit, and that could lead to some compression on those PE multiples as well, which remain quite high.
So Gary, we're in very interesting times. I mean, as you say, if we're getting more rate hikes from the U.S., which the market hasn't penciled in, and maybe higher yields, this is also a time where Japanese yields have started moving higher. So given this flux, what's the best guess? Could this money head its way to Asia, to emerging markets, as there's perhaps some risk aversion that develops in the U.S.?
Less risk aversion than perhaps money moving at the margin back to Japan. We have several $1 trillion of money that has flowed overseas as a result of those artificially low interest rates due to yield curve control over the past couple of years. As those yields are allowed a little bit more flexibility, we could see money moving certainly out of the U.S. And some of that going back into Japan to the benefit of the yen, to the detriment of the dollar and the U.S. bond market. I don't see that as a major driver, but certainly at the margin, given everything else that's going on, the fundamentals I mentioned turning a bit, that could create an added headwind for the bond market.
All right, Gary, we'll leave it there. Thank you very much for your time, and it's a pleasure, as always, speaking with you here on CNBC-TV18. We'll take a quick commercial break here. A list of top stocks to watch with a research team coming up next. Stay with us.
Welcome back. So let's take it down to stocks. We know that the global setup is a little iffy. Qs aren't very, very positive, and the GIFT Nifty is telling you the implied opens down almost 60-odd points. But what about stocks? Well, our team is standing by with the list of CNBC-TV18 top stocks to watch out for this morning. Guys, happy Wednesday to all of you. Let's start off first with the auto sales data that's been trickling in. Reema, tell us about the numbers.
Let me start with Ashok Leyland, where we've seen strong sales in the month of July. On a year-on-year basis, July monthly sales are up 11%, and the growth has been led by MHCV. Hero MotoCorp continues to disappoint. Remember, even June was a dismal month, and even in July, the total sales have fallen by 12%, and the company says it's on account of inclement weather conditions in July. There was crop damage in several states, and that's the reason why the sales have been on the weaker side. For TVS Motors, it's a mixed bag. Now, the total two-wheeler volume growth has gone up by 2%. But here, the domestic volume growth is strong at 17%, but exports have seen a steep fall. So overall, we've seen a mid-single-digit kind of growth for volume growth for TVS Motors. Eicher Motors continues to clock very strong monthly sales numbers. Total sales have gone up by 32% on a year-on-year basis. So going with green for Eicher. Back to you.
Okay, all right. Thanks a lot for that, Reema. Well, let's hop across to Abhishek. He's here to tell us about Chola Investment. Morning, Abhishek. How are the numbers?
Nigel, the numbers are below pole in terms of the earnings momentum. Overall, a weak quarter per se in terms of profitability. So, a board has approved fundraise of 4,000 crore via QIP. Disbursals are strong at 50% growth YOY and a decline of 4.8% sequentially. The AUM growth is robust at about 41.5% YOY and about 8.8% sequentially. However, the cost of funds has weighed on the performance. So, the net interest margin is at 11-quarter low of 7.3%, and this is below the guidance that the management had given to analysts. Decline is very sharper over there. A gross NPA ratio at 9-quarter low of 4.3% and net NPA ratio at 10-quarter low of 2.77%. In terms of P&L versus poll, the NI is slightly ahead of our poll. However, the PAT is below our poll. In terms of brokerage's view, CLSA has downgraded the stock to outperformance from buy. Target price is at 1,250 per share. Morgan Stanley has an equal rating on the stock with a target price of 1,000, and Jefferies has a buy recommendation and a target price of 1,350 per share. Back to you.
All right, and you can catch the management at 9:40 this morning. Chola investment on the program. Well, let's move on. Thermax is the next one we're going to focus on. Vivek has got details. Vivek, morning.
Well, good morning. Largely along expected lines, Thermax has delivered a steady quarter. So now on the back of improved performance, the company sales in both the industrial products and the chemical segment, revenues have jumped up almost 17% on a year-on-year basis. On the back of that, with strong operational efficiencies, EBITDA too is up almost 37.5%. EBITDA margins have gained almost 100 basis points on a year-on-year basis. However, due to the impact of 51 crores on the bottom line due to an ongoing litigation, profitability is up only 1.7%. Two key figures that we're tracking: the order booking is up almost 11% again on a year-on-year basis. Order booking in Q1 coming in at 2,567 crores. Order balance on the order book currently stands at over 10,500 crores. Macquarie sales, post the results, what they're saying is that the strong order inflow indicates that the base order momentum continues to remain quite robust, and which is why we are going with a green on this particular name.
Okay, got that. Vivek, thanks very much. We'll keep Thermax in mind as well. Mangalam is joining in. Shoes and some bhujia this morning. Earnings for Metro as well as Bikaji. How do they look?
Well, bhujia is a lot better than shoes, I must tell you. As far as the shoes are concerned, for Metro brands, the revenues grew by about 15-odd%, but that didn't translate much into the EBITDA. The EBITDA grew by just about 2%. This because of, the operational expansion that the company has been doing. They've been opening stores, and at the same time, a lot of consolidation coming in from Cravatex is also weighing down on their bottom line, as a result of which the net profit, the consolidated net profit, fell by about 12-odd%. Employee expenses were up by 35%, other expenses up by 39%, and depreciation was up by 39% as well, and loss coming in at 14 crores from the acquisition of Cravatex. Bikaji, on the other hand, remember same time last quarter, palm oil prices were going through the roof, were at historical highs, and from there we've seen a big cut, as a result of which their margins have seen a sharp expansion, all the way up from 7.3% to 13.6% on the EBITDA front. And this despite just a 15% revenue growth. The company's profitability has grown by almost 165%. That's a big positive. But remember, the stock has already rallied about 20-25% in the last 1 month. So let's see where it goes from here. But for now, for starters, there is a fair amount of crunch.
Okay, well, do remember you can catch more with the management of Bikaji Foods. We chat with them at 9:30 a.m. this morning.
Okay, all right, let's get in some other numbers as well from the broader markets. Rima is back with us to tell us about Redington as well as Sansera Engineering. How are the numbers, Rima?
For Redington, there is a big decline in the margins for the company. So there is a margin miss. Current EBITDA margins are at 2%, which compares with about 2.5-3% that the company used to see. So it's a sharp margin contraction, and that's resulted in a 21% drop in the company's profitability. So the top line is good, but there is margin weakness, and the company is saying it's on account of higher interest factoring charges, and this will only settle down, normalize in the second half. Sansera Engineering is the other one that I'm looking at. Looks like a steady set of numbers. Top line growth 24%, margin steady at 17.3% year-on-year, profits are up 30%. But the good thing is the margin improvement on a quarter-on-quarter basis. On a quarter-on-quarter basis, Sansera's margins are up 180 basis points. Back to you.
Okay, got that. Thanks very much, Rima. Let's go across to Surabhi. She's watching out for a couple of stocks as well. Surabhi, morning. Which ones are those?
Morning. So first one on my radar is Syrma SGS on the back of results and an acquisition. So let's start with the results first. It has seen a good revenue growth of over 50% on a year-on-year basis, but margins were impacted. Gross profit margins were down nearly 600 basis points. The EBITDA was up 10%, but the margins were down 250 basis points, came in at 6.1% versus 8.6%. The PAT was up 66%, but that was aided by higher other income and also gains on Forex. Additionally, the company has acquired 51% stake in Johari Digital Healthcare for 230 crores. They're going to pay an additional consideration of 28 crores if they've achieved certain predetermined milestones. Now, Johari is a medical devices manufacturer. It had a revenue of 163 crores for FY23, which has grown at an 80% run rate for the last 2 years. Sula Vineyards is also on my radar. They've received an excise duty notice of 116 crores from Maharashtra Excise Ministry. And Sterling and Wilson Renewable is also on my radar. The company has won an EPC order worth 360 crores. For Q1 of FY24, they had an order book of 4,900 odd crores. So we'll see which way this moves.
Okay, got that, Surabhi. Thank you very much for all the details. We'll watch out for all of those stocks. Well, that's our top 10 list. Let's quickly recap all the stocks. Ones that have positive news flow around them today are Bikaji Foods, Sansera Engineering, and Sterling and Wilson. Stocks with negative news flow, more of those than the greens today. Cholamandalam Investment, Metro Brands, Redington, Syrma SGS, and Sula Vineyards. Auto stocks could be mixed on the back of the July sales data that we've got. Okay, let's dive straight into our first earnings call this morning. Syrma SGS is on our radar. As we were just telling you, the company has recorded a strong revenue growth if you are comparing it year on year. But gross profit margins have been under pressure. In fact, they've declined almost 600 basis points. JS Gujral, MD at Syrma SGS, is with us now. Mr. Gujral, thank you for joining in. Good morning to you. So it's a very strong 54% growth if you're looking at it year on year. But given the way your stock listed and the way it's rallied, I think the market just wants more. First thing is, if you compare the growth quarter on quarter, then there is a deceleration compared to Q4. And the bigger issue is on the margins. Gross profit margins down 600, EBITDA margins have fallen year on year. So can you just explain to us exactly what's gone in, what's happened in Q1?
Okay. You see, on the top line growth, Q1 typically year on year is a low quarter. It typically accounts for approximately around 20% of the total revenues, and the Q4 accounts for about 30%. So that secular trend over the years is there. So hence you see a de-acceleration in the growth, top line growth vis-a-vis Q4. But then that's been the trend all in the past also. Now on the margins, I think this is a one-off aberration. Healthcare, we are into healthcare business of RFID devices. That has taken a 1 quarter hit. I'll just give you the figures for your reference. Q1 of 22-23, we did a 54 crore rupees of healthcare business, 55 crore rupees of healthcare business. Q4 of 22-23, we did a 45 crores healthcare business. Q1 of 23-24, we have done less than 15 crores. So 40 crores hit on the top line vis-a-vis Q1 and a 30 crores hit vis-a-vis Q4. And this business is approximately 40-45% gross material margin. So 40 crore hit on the top line with a 45% gross margin translates into 17 crores loss of EBITDA and margins.
Okay, so this and this will be recouped, Mr. Gujral. So what will
but this, as we
numbers
speak,
from here look like in FY24? Go on.
As we speak, we have already done about 10 crores, little less than 9.95 crores in the month of July. And we expect that Q2 would be about 30 to 35 crores. And then the momentum would go up in Q3 and Q4.
All right.
So we maintain that this is a one-off aberration in this quarter.
Okay.
And second point which I would like to highlight is on the foreign exchange. So these are disclosures. Foreign exchange is essentially related to my purchase and sale. So it's a direct operational income or operational loss. That's why we have shown it, we take it as a part of the operations and not part of the treasury income because it's not related to the treasury.
Okay. All right. Mr. Gujral, we get that point that you're making, but give me three big numbers. Okay. What is your current order book? Point number one. Earlier, you were talking about growing by 35 to 40%, 45% for this year. Is that on? And what is the margin trajectory from here? Order book, revenue growth, and margins.
Order book, we had an order book of 3,000 crores as of March. As of June, it has grown up to 3,500 crores. We maintain that we'll grow at an industry plus average rate. And the first quarter, we have grown by 59% over the last quarter, previous year quarter. So I think the top line revenue, guidance is intact. We are on track. And on margins, we have all the time been maintaining that we would be a around double-digit EBITDA margins on the organic business which we are in. We still maintain that we are there. There is no significant erosion in that.
Okay. Mr. Gujral, this acquisition that you have also announced, it kind of opens up a new market for you, medical devices in that sense, right?
Yeah.
Very briefly, could you tell us what this will do to your overall revenues? I think I have some numbers. This company which you've acquired, which is Johari Digital Healthcare Limited, is expected to do about 70 odd crores in profits in FY24.
Yeah. You see, our philosophy of acquiring a company was where it fulfills the gap in my product offerings or gives me some regulatory approval, which otherwise would take 3-4 years. And on both these accounts, Johari Digital comes out very well. They are approved by almost all the developed worlds, America, Australia, Canada. There are about 15 or 18 products which are FDA approved. And they have a very strong depth in R&D. Now, we believe that with Sirma's global reach, the management bandwidth, and the expertise in a very efficient manufacturing, it would leverage the Johari Digital technical competence to give a winning combination. We believe that in the current year, it should add approximately anything between 170 to 200 crores or 180 crores, 190 crores in our top line. And as you said, about 70 crores, 65, 70 crores to EBITDA. It's a very high EBITDA margin business, which is more than 30%. So it fits in very well with our strategy of entering into a very lucrative area where we were not present.
Okay. So that's about the acquisition. Just very quickly, you said the top line growth for the current year should be around 45%, if I heard you correctly, Mr. Gujral.
I said industry average plus.
Okay.
So if the industry grows
above
at
industry.
35, if industry grows at 35, I'll grow at 35 plus. If industry grows at 40, I'll grow at 40 plus.
How much faster than the industry will you grow, sir? How much faster than the industry will you grow? If industry grows at 35, you will grow by what?
About 10-15% higher. 10% higher.
10-15% higher than industry. Okay, got that. So just very quickly, divide the growth for us. I mean, Q1 healthcare had that one-off issue, as you mentioned. But between auto, consumer, industrial, which are going to be the biggest contributors for you in terms of revenue, and which business do you think will be the most margin accretive? Now you've done this acquisition on the medical devices side, so will it be healthcare? From a margin profile point of view, which will be the most accretive business, and which one from the revenue point of view?
Healthcare, exports, ODM are margin accretive. Consumer, automotive are revenue accretive.
Okay.
And we believe that in the current year, consumer, automotive led by EV, as well as industrial, would almost see a secular growth of between 20 and 35% each segment. Some may grow a bit higher.
Okay. Mr. Gujral, with respect to this acquisition you gave us, what this will add, Johari Digital will add in FY24, it's meaningful to your business, so both top line and bottom line.
Yes. But top line, it will be okay. Top line, it will be about 5, 6, 7%. Bottom line, it will be significant accretion.
Right. Is there can you scale this up? Do you expect a significant scale up in the coming years? Because this year, you've acquired it during Q1. Do you expect this to ramp up significantly? And briefly, what kind of numbers are you expecting here?
That is the plan. I believe that with our global reach and the management bandwidth, we should be able to significantly scale this business up in the coming. I'm not saying of this 3 quarters of remaining this financial year, but going forward, I think it will form one of our significant high profit growth areas. And the management focus will be to significantly grow this business.
Got it. Thanks very much for joining us, Mr. Gujral. Appreciate you joining in. And thanks indeed for taking us through all of those details. So numbers and quarter-on-quarter numbers are a little soft, but that's a one-off, as Mr. Gujral explained. And then there is this acquisition as well. Now, Maruti sold a total of 1.81 lakh units in the month of July. In the domestic market, it retailed 1.5 lakh units, while exported 22,200 units. UV segment witnessed a growth of 166% in the month of July. My colleague Parikshit Luthra caught up with Shashank Srivastava, Executive Officer at Marketing and Sales at Maruti, and began by asking him how SUV segment helped Maruti to post more than 1.8 lakh units in the month of July, and whether this trend can continue. Listen in.
UV performance has been really good, as you just pointed out. And to simplify, UVs can be broken down into 2 parts. One is the MPV segment, where we have the Ertiga XL6, and the SUV segment, where we have 4 vehicles, the Brezza, the Vitara, Jimny, and the Fronx. So the MPV segment has seen a sudden spurt, largely because we've been able to get a good production in the month of July because of the semiconductor components better availability. There was always a demand in that segment, and we had, as we had been discussing, a long waiting period for our XL6 and the Ertiga. So it was a very good month in that sense from a production point of view, and that's why you see a large jump in the MPV segment. In the SUV segment, both the availability and the introduction of all the 4 models, which are now in full swing, I would say, the Fronx and the Jimny, which started in the last 2 months, the Brezza, for which there was an increased production, and the Vitara, we were able to become actually the number 1 SUV maker in the month of July. We had about 42,600 vehicle sale. The next manufacturer had about, I think, 36,000. And hopefully, going from here, we will try to achieve on a cumulative basis also our objective of being number 1 in SUVs.
All right. So you're saying that you became number 1 in SUV sales in the month of July. Give us a sense of how you would increase production. For example, in wholesale, you sold about 62,000 utility vehicles. The production in the month of July was 54,788. How do you expect this production to go up in the next few months? And what is the order book that you have currently?
So currently the order book is about 3,35,000. And yes, as we discussed, Parikshit, that the semiconductor issue seems to have got better. And while we lost about 28,000 vehicles in production in the Q1, but July we were able to go full swing. hopefully going forward, this trend will continue and we will be able to reduce the waiting periods and increase our volumes.
Also, the contraction that we have seen in passenger car sales, especially that of the Alto, the Espresso, the Baleno, Celerio, Desire, Ignis, Swift, Tourist, Wagoner. There's been a 27% contraction in passenger car sales. Is this something that you're concerned about?
Actually, much of this, the decline that you see is largely because of the Alto. Because, when you compare it with last year's figure, we had the Alto 800, which we had discontinued. We have introduced the Alto K10, which was also there in a small number last year. But we have not been able to fully make up those numbers that we lost in Alto 800 with the Alto K10. In fact, Alto 800 numbers used to be in that 15,000 range. So that is what we are trying to do, although admittedly the Alto K10 price point is significantly higher than what Alto 800 used to be.
Well, that's the Maruti management. We'll take a quick commercial break here, but on the other side, Devin Choksi of KR Choksi will be joining in to discuss some stocks, results, and themes he likes to bet on. Stay with us.
Welcome back. You're tuned into Bazaar Morning Call. You're on CNBC-TV18. Well, we discussed a lot of stocks, so let's get in Devin Choksi of KR Choksi to help us analyze some of that. Hi, Devin. Good morning. I wanted to ask you about Chola. Chola has been a very, one of the best performers. Valuation-wise, it's not cheap. What do you make of the numbers? We'll also be joined by the management at around 9:40 a.m. today. But your take on the numbers?
Nigel, good morning. At a cursory look, I think the numbers look, quite convincing and impressive as I see it. The overall growth in the portfolio is largely coming in also because of the fact that I think there is a significant amount of revival in the commercial vehicle segment. And that is where probably I think you are seeing the likes of Chola, likes of IndusInd, who has a strong portfolio of lending. I think they are basically getting a higher amount of traction. Even the pre-owned vehicle market, I think itself is also growing, and that is where again I think these companies are very well positioned, particularly in the rural India. So that is an area where I think they are generating significantly higher amount of margin as I see it. But I think we'll have to take a deep dive into the numbers to understand the strategy going forward and how much growth further it can target going forward.
Okay, that's Chola. Devin, good morning. Good to have you on the show as always. I wanted to ask you about Ashok Leyland, because we're just looking at the monthly sales numbers, and at least after a long time, it seems that on the CV side, especially MHCV, the numbers have started looking good. So how do you view the valuations right now, and would this be a stock that interests you?
Yes, Surabhi, good morning. Well, Ashok Leyland definitely remains, I think, one of the top picks as far as we are concerned. It is continuing to be top pick, I think, for last, at least, I think, few quarters, if I may say so. Largely the premises, of course, I think you are getting them reflected in the numbers, but largely the premises that overall growth in the business is happening largely because of higher amount of logistic activities which have started happening into the industry. On the other side, government spending on the infrastructure is demanding higher amount of heavy truck orders, I think, which are continuing to do so. So industry is continuing to bring MHCV orders, heavy commercial vehicle orders come from the infrastructure spending which is there in the industry. And rural India is continuing to offer the demand more on the light commercial vehicle side. So all in all put together, every portfolio of the company, including the buses, have actually started getting higher amount of traction, largely because of the spending which is happening into the economy. One key factor which we believe is going to make a larger difference going forward is the replacement market that we are talking about due to the scrappage policy. Now, the replacement market would probably systematically come and grow. At this point of time, we are seeing a slow entry, but it is likely to grow faster. And should that happen, then additional 2.5 lakh new vehicles are going to be in demand. And that is now going to continue for next 3 to 5 years as I see it. Should this be the situation, the likes of Ashok Leyland, likes of Tata Motors on the commercial vehicle side, they remain relatively more convincing buy into the portfolio. And maybe I think the valuation factor, which was up till now at the higher side, is now getting rationalized. So their stocks are not looking expensive on the projected working of the company, which is likely to remain on the higher side.
Okay, got that. We'll keep that in mind. Devin, thank you very much. Little short on time today, so many earnings, but really appreciate you joining in with your insights on these stocks. Well, with that, let's quickly go across and say hi to Anuj and find out how he's reading the setup today. Anuj, good morning. I mean, global cues can be as negative as they get, but how do you look at the market overall?
Yeah, I mean, global cues are negative. You'd want to give some kind of a bravery about to Fitch, rating agencies normally come and announce things when they are too obvious. So I don't think the market really gives too much importance to that. But back home, Surabhi, our market is fine. It's just that the Nifty is not reflecting that because we have some kind of a leadership crisis in the market. I mean, look at some of these big stocks. Lever is down 8% from the highs. ITC, which used to make lifetime highs on a daily basis, is down 7% from highs. And these two really make a big difference. HDFC Bank, which is about 5.5% from highs, and TCS, which is about 3.5% from the highs. And if you see the next plate, there also you would see some big plates, which are off the highs. SBI by about 3%, ICICI Bank by by about 1.5%. Reliance 5%, actually 12%, but 5% because I'm adjusting it for JFS, where we have the constant price now. So even that stock is about 5% off the highs, and that really is the problem, because otherwise, yesterday also, the mid-cap index hit a new high, small-cap index hit a new high, and advanced decline was quite strong. So overall, as such, the market does not have a problem, except for the leadership, which is not letting Nifty, get past that 20,000 mark. Now, as far as Qs today are concerned, for me, the big Q today is Ashok Leyland's monthly numbers, because that tells you the kind of CV cycle that we are in right now, and which means that the market, the economy is strong. The negative, though, is coming from the global side, the way Brent crude is surging and the way dollar is going up, because if commodity inflation comes back, that takes away one basic positive from your own market, which is the interest rate factor, that rates have peaked and maybe even a cut will happen. Now, the cut might be still some time away. So that, I think, is the only risk factor. Finally, coming to the trade setup, and over there, what's interesting is that the markets for last 2 days made a higher high and higher low. The Nifty, that is. If you look at that chart, after consistently making some lower lows, you saw that trend change. And yesterday, even though market came off the highs, both the high and the low are higher than the previous day's low. As I said yesterday as well, the number to keep an eye on now is 19,563, which was also the first day low, also the 20-day exponential moving average.
All right, Anuj, thanks a lot for that. Well, time to slip into a short break. When you come back, our technical experts will be with us. Mitesh Thakkar and Sudarshan Sukhani will be joining in to give us their trading strategies. Don't go anywhere.
Okay, welcome back. Just about 6 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with what they make of things as we start another day. Gentlemen, good morning. Mitesh, to you first. How are things set up On the index, what kind of trade would you want to put on?
Morning, Prashant. Last few days I've been advocating a ranged kind of a outlook for the index, and I think that still continues. If you look at the Nifty's price movement, I think yesterday also, I think it was a very narrow range, broadly making a high of 19,795 and a low of 19,704. So not even 100 points. I think most of the volatility indicators are turning flat, which means that this 19,580, 600 on the lower side, give and take few points, and 19,850, 900 on the upper side will be the range. And I think next 5 to 6 days, I expect the index to consolidate within this range. So it will be choppy, but try to buy near the lower end with a 50, 60 point kind of a stop loss. And as we approach 19,820 odd levels, try to take profits or even attempt a short by buying put options. So I think that's the way one should approach the market, especially in a range choppy kind of a market.
Okay, got that, Mitesh. Sudarshan, what about you?
Good morning. See, yesterday the Nifty gave us two technical cues. The first was its failure to continue making, say, higher levels. It found resistance and retreated from there. That tells us that at least for the time being, the uptrend, the short-term uptrend is stalling. And the second was a very narrow range day. Now, narrow range days are usually days of confusion. The market doesn't know whether it should go up or go down. The next day, this is resolved. The chances are we'll see a choppy market with lower levels. Now, in the Nifty, I never advocate going short. So it's best to avoid the Nifty for the day, do nothing. The trade is coming in the Bank Nifty, which is a much weaker chart as compared to the Nifty. For the Bank Nifty, an intraday short is justified, which is to buy put options, put an appropriate stop loss, and see where the market goes. So all in all, both markets are likely to be choppy, with the Bank Nifty having a downside bias.
Downside bias. Got that. Gentlemen, do stay on. By the way, Asian markets have taken a turn for the worse. The Hong Kong market's down about 2%. Nikkei is down 2%. Lots of red across Asia this morning. We will take a quick break, come back, and we'll get to some stock ideas on the other side. We'll have the pre-opening rates. And also, we get chatting with the management of Metro Brands on their Q1 performance.
Welcome back. We'll almost got into pre-open. We'll get the rates in just a bit. For the time being, let's get in our some picks from our technical experts. Sudarshan, you go first. What are the picks you have for us?
Well, it's a mixed environment, and I've explained why markets are likely to be choppy. In that choppiness, Naukri, which is a symbol for Info Edge, that's a buying opportunity. A correction is probably getting over in it. Buy with a stop under 4,500. Lupin is making lifetime new highs. That's always interesting, worth buying into. Remember, both are positional trades because for the day, choppiness is likely to be the key. So Lupin is a buy with a stop under 960. IGL is an intraday short. The stock has a very poor chart and it's breaking significant support levels. Short with a stop above 466. And similarly, Godrej Consumer Products is another intraday short, stop above 1040.
Okay, by the way, there's been a huge block trade on Unichem. Some 33% of the company's equity has changed hands. Of course, you have to wait by to see the buyers and sellers, but it could be IFCA because that was the deal. IFCA was buying a large chunk of equity from Unichem promoters, and that deal has happened in the block window. So more on that as we go forward. But Mitesh, your stocks for today.
Yeah. So Survi, good morning. I have more of buy calls today. IT was one of the clearly strong sector yesterday, and I have Coforge as a recommendation. Buy with a stop at 47.80. Look for targets of 5,000. Jubilant Foods is a buy with a stop at 480. 480 for targets of 504. And a buy on Aarti Industries, which is a conditional buy. I would want to see the stock get past 480. Buy then with a stop at 470 for targets of 505. And DVs is the solitary sell call with a stop at 36.81. Recommend taking a short here with a target of 35.60.
Okay, all right. Mitesh, just stay with us. I wanted to ask you about Vedanta. Just observing yesterday, it's moved into a bit of a discount. Normally, when we see that discount widen on Vedanta, maybe the street is waiting by for some kind of dividend. I don't know whether there's any kind of other corporate action that the street is waiting for, but that's one notable stock. It's underperformed the metal index, and it's trading at a bit of a discount in the futures. How are the charts looking, Mitesh?
In fact, the metal pack has done very well. If you look at the ferrous metals particularly, and even Hindalco and Nalco, they've done very well. But Vedanta, if you look at it, it's still consolidating. Unable to get past levels of 285, 290 on the upside. While on the downside, 270 to about 266 is showing very strong support areas. So I think the stock chart does suggest that we will be possibly sideways for another few days to come by. Only a breakout about 285 to 90 zones will trigger some kind of a stronger.
Okay, gentlemen, we'll leave it there. Thank you very much for joining us, and good speaking with you here on CNBC-TV18. Well, that's the technical aspect coming through. Well, let's just have the pre-open briefly. The rupee is also opened. It's opened at about 82.38 compared to 82.26. Nothing in the currency side of things as well. Even as the equity picture, as Surabhi was mentioning earlier, across Asia over the last 15-20 minutes has worsened a little bit. Nifty's around 40 in the pre-open, by the way. Well, it was a soft quarter for Metro Brands. Their expansion expenses hit EBITDA while profits declined on high depreciation. Nissan Joseph is Chief Executive Officer at Metro Brands, and he's joining us now to take some questions. Mr. Joseph, great to have you with us here. Thank you very much. Has there been, have you seen any general slowdown in discretionary spending in the quarter? I mean, that kind of thing build up?
So thank you for having me this morning. I think it was actually, when you look back at it, it was actually a good quarter for us because there was a lot of normalization that happened through this quarter. So last year, we had our best quarter ever in terms of growth post-pandemic. And last year, we had no closures. We had a lot more wedding dates, and there was a lot of pent-up buying and a lot of wardrobe refreshes that happened. Given all that big push into the quarter last year, to come out at this side of the quarter on this year and be that close to that target, I actually am quite pleased with the numbers. The other point on demand that you bring up is, we've seen growth in our e-commerce business of about 68% quarter on quarter, which also signifies that the demand continues to be strong because e-commerce did not have any pent-up buying last year that they had to comp this year. That's number one. Number two, when you look at our growth on the products over 3,000 rupees, we went from 44% in the previous quarter to 49% this quarter. So that also shows that the premium consumer is out there shopping and willing to spend their money at Metro Brands.
Mr. Joseph, what's the same-store sales growth for Q1, and what's the outlook you have on that for the rest of the year?
So we don't break out, Surabhi, our numbers by like for like. Having said that, though, I think we were within the same pin code on those numbers, as you can decipher looking at our growth and calculating the new store effect that we would have had. However, as I look to the coming quarter as well, we did continue to see pent-up demand go through about 6 months, well, probably 4.5 months, which goes into Q2. And this year, don't forget, travel is up big, eating out is up big, whereas last year we were still wearing masks on planes and masks in restaurants. So given all that push on the discretionary dollar, or the discretionary rupee, sorry, I'm actually quite pleased that we have come out with the numbers we did. And if you really look at our standalone numbers, our profit was up. Our EBITDA continued to be in the 35% range. Surabhi, we've always guided that our profits would be the PAT would be somewhere between 15 and 17%, and our EBITDA would be in the 35% range. So while we were trying to comp and go against some very big numbers from last year, the fact that we've continued to hit those numbers in terms of the measurables of PAT and also EBITDA percentages makes me feel very good about the performance of the team, but also to see that the demand continues to be very strong for our products. The fact that, as I mentioned, that we could be in the same zip code as we were last year with all that pent-up buying and wardrobe refreshes and auspicious wedding dates that seem to be jammed into Q1 of last year.
All right. Hi, Mr. Joseph. Good morning. Give us a few numbers then. Store openings, I think, in the first quarter were around 27. For the year, I think you were gunning for close to around 100. Do you stick by that? Point number one. And also on the acquisition, Cravitex, which is Fila, you have done close to around 17 crores. What is the run rate you do for this year?
So, when we looked at our new store growth, we had upped our guidance to open 200 stores in 2 years at the last call. And we're very much on track with that. I feel very comfortable with that number as we look to our runway and our the sites, the Whitefield sites that we've identified for our new stores, both from a backfill strategy. So where there's a metro doing well, we know we can go and backfill with other banners that we have, or whether it's Mochi or whether it's Walkway or Crocs or FitFlop. I also feel that there are new cities that we will continue to look at. Last quarter, we expanded just to 8 cities. We've identified over 50 cities that metro could eventually be in. So when I look at the growth runway, I feel very optimistic that that number is something we would definitely hit. When we look at Cravitex, we've spent all our time ensuring, as I mentioned before, cleaning up the inventory, rationalizing our distribution, and repositioning the brand. And the run rate that we look at is going to be very dependent on how fast we can liquidate product. We can expect Cravitex to be a little bit of a drag on our profitability through this quarter and maybe the start of next quarter. But by then, our goal of having cleaned up that inventory and repositioned Fila brand so we can start unlocking the potential of Fila would be well on its way.
So when you say the drag will continue, maybe Q2, a little bit of Q3, should we expect that perhaps Q3, if not Q3, Q4 onwards, Cravitex will become positive at the EBITDA level?
Yeah, that is our target, though we're not trying to give any forecast definitely yet. But, I firmly believe that we should be able to, and we will be able to rationalize the distribution, which adds a lot to the bottom line of that standalone business unit.
Okay, you mentioned that, we're still on track with store openings. I think the earlier number that you gave us was about 260 stores over 3 years. How much of that growth will happen this year, FY24? The reason I also ask is just trying to pencil in if that means higher store opening costs that could perhaps keep putting that pressure in the near term, at least, on the margin line.
So just so you know, we upped our guidance. We were at 260 stores over 3.5 years when we first went public, Surabhi, but then we've upped it to 200 just on the back 2 years alone, having well exceeded the first half of the year. So from that standpoint of the original 260 stores, we're going to by far exceed that number, right? And thank you for pointing out the EBITDA drag. As you know, Ind AS expects us to put a lot of depreciation into the first year of a new store, and that's why you would see some pressure on the EBITDA. However, despite that pressure from all the new stores that we've done, and with the Ind AS reporting, I'm very pleased that we had a 35% EBIT.
Okay. All right, Mr. Joseph, we will leave it on that note for today. Thank you very much for joining in and giving us a lot more detail on the business and the outlook ahead for the year. That is Metro Brands. Numbers looking quite all right at the end of Q1. Margin pressure, as he explained, because of a lot of the new store openings and this new acquisition, Fila, which they've done, which for the time being right now is loss-making at the EBITDA level. Anyway, we've got the pre-open rates, a very, very quick glance on what the Nifty is doing. We've got about an 80-point decline on the Nifty and a similar sort of a cut on the Bank Nifty as well. That's a 0.7, 0.8% kind of a drop. So that's what we are geared up for. Now let's look at some more stocks that should be on the radar as we hit that opening bell. Sonal is joining in on Oberoi Realty. Sonal, why are you watching this one?
Well, Oberoi Realty reported numbers over the weekend of Friday, that is, and the numbers, the commentary that we've got from the brokerage is not very positive. Most of them have downgraded the stock as well after a weak set of numbers. CLSA has downgraded the stock to a sell. The target price has come in at 1,052 rupees. Pre-sales in first quarter was subdued. Company expects better second half of FY24. It is driven by revival of projects in Worli and Mulund projects. They've also taken price hikes at their Worli and Goregaon projects, but they think that the improvement that company is talking about, that has already been priced in the stock price. Motilal Oswal calls it a subdued quarter. They say management is indicating actively discussing potential acquisitions of new land parcels. They believe management may adopt a cautious approach towards business development. At this market price, the company is trading at 30% above its total net asset value, and that's the reason they have downgraded the stock to a neutral. Jefferies also says they find near-term triggers priced in and they wait for conclusion of significant new land deals. They maintain a hold. Goldman Sachs also has a neutral rating on the stock. They think that blended pricing has remained flat on a quarter-on-quarter basis, and the triggers will be something they'll be watching out for.
All right. Thanks very much, Sonal, for that. That's Oberoi Realty. PVR Inox is the other one which will be in focus. I mean, Q2 will see all of that impact of Barbie and Oppenheimer, etc. coming up. But Surabhi is here with a review of Q1. Surabhi.
Thanks so much for that. So they declared the results in the last hour of trade yesterday, and Q1 was not bad. Sequentially, the revenues were up 14%, the EBITDA was up 33%, the average ticket price, that was up 2%, and the spends per head, that was up 10%. The brokerages also have a similar view. They said that, sequential performance was good, and the July data suggests that the Q2 is likely going to be a strong quarter. Management has indicated that growth is going to come from improvement in ticket prices and also recovery of ad income. Recovery of the Hindi cinema and merger synergies are some of the key catalysts going forward. All the brokerages have a buy rating and a positive view on PVR. The highest target price coming in from UBS at 2,100 rupees per share and lowest from HSBC at 1,920 rupees per share.
Okay, got that. And of course, we will be chatting with Nitin Sood, CFO of PVR, very, very soon. So watch out for that interview as well. But some more stocks before we hit the opening bell. Abhishek, remind us on Chola Investment. How are the numbers?
Well, the earnings is weak over there. Take a look. The business momentum is strong. Disbursements and AUM growth is pretty robust on a YOY basis. However, the net interest margin is at 7.3%, which is the lowest in last 11 quarters and much below management guidance as well. Asset quality has improved. Gross NPA ratio is one of the lowest in last 9 quarters. But in that, the gross NPA of the new business that they have undertaken in last 12 months, that is around 4 to 5%, which is on the higher side. In terms of PNL versus poll, NI is ahead of our poll. PAT is below our poll. CLSA has downgraded the stock to outperformance from buy, and target price from brokerages remain in the range of 1,000 per share to as high as 1,350 per share. Back to you.
Okay, all right. Thank you very much for that. Chola Mandalam, of course, remember we'll be speaking to the management there as well. Arun Selvan, President and CFO, that's coming up in just about 20-25 minutes from now. But for the timing, we have to look out for the opening bell. It is promising to be a bit of a dip at the start. The question is whether that dip gets bought. Nifty at this level is just above the 20 DMA. That level comes in closer to 19,616. So let's see if the bulls can take support there and if there's going to be some buying or not. In terms of the stock reactions, I think Sula is one more name beyond all the earnings stock. Sula, because of this excise notice that the Maharashtra government has slapped on them, it's a little over 100 crores. That stock is under pressure as well as we kick things off this morning. So let's see if markets can take this Fitch downgrade of the US debt in their stride or not. 3, 2, 1, off we go, and there's the bell. 60 down at the start. That's what the Nifty is giving. Immediately, let's talk about where the weakness is coming in from. Hero Motor is still suffering the blushes from yesterday, 2% lower again. Hindalco, Tata Steel, some of these metal stocks, global-facing ones, they're weak. L&T, HDFC Bank and TCS. These are your three big boys, which are starting on the negative side today. The buying that we saw in IT last afternoon, that's getting quickly undone. Tech Mahindra is lower, Wipro is lower, LTI, Mindtree, TCS I mentioned. So IT is definitely no pillar of support this morning for the market. Nifty is now down about 80 points. So let's see how that goes. On the upside, fighting for the bulls, well, actually hardly anyone. Supply is the only one, up about 0.5%. Coal India, well, not even able to put on more than 2 rupees. UPL is trying to recover from the losses that we saw in the earlier part of the week. And that's about it. So basically, the headline is there's no firefighter. And it's a single one-way drop right now, 80, 85 points down on the Nifty as we kick things off. Nigel, so yeah, it's 90 points. It's I think people probably just waiting for things to settle a little bit before deciding what to do. We're still above the 20 DMA, 19,640 for now.
Well, that's right. So, we need to also keep an eye on Ambuja Cements. The numbers have just flashed for our viewers, and it's looking pretty much in line as we speak. So, I think, we'll just analyze that in just a bit. But the stock is down close to 100% now, but I think those numbers are more or less in line. A few stocks we should be looking at. Tata Chemicals, they've gone ahead and cut prices. Stock is down close to 3.5%. Chola Investments, a bit of a miss in terms of numbers, trading at peak valuations as well, so that's down close to around 2.5%. HDFC AMC, well, that's down close to around 2% as we speak. On the gaining end, well, what's doing well? India Bulls Housing Finance, well, that's been moving well in the last few days. That's up close to 2%. NCC is up close to around 1.5%. And PVR Inox continues to build on to the gain. So good going on that front. The Nifty, well, we're holding around that 90,650 odd. As we mentioned earlier today, the 20 DMA, well, that will be a crucial level that we need to track on the Nifty. For the time being, that level's being held out. But on the Nifty Bank, that level's got taken out. The 20 DMA, we're just trading a little bit below that level. Yes, sir.
Just wanted to point out, look at the reaction on Sirma SGS. It's not just the stock, it just tells you the market's mood when the market bids up stocks so aggressively. The moment there's a slightest hesitation on earnings, and the management came in and explained everything, saying it's a one-off on margins, etc. But for the time being, it's just take money off the table. 5% down on Sirma as well, 70, 80. So trying to stabilize around these levels for the time being, Prashant.
I mean, valuations, right? 60, 70, 80 times now is a given. Returns are, across the board when you scan stuff, between 70 and 100% gains this year for so many names. These stocks like Sirma, etc. have done very well. Let's just quickly look at Chola as well for a brief bit and see. Remember what happened after the last quarter numbers? I mean, there was a complete blowout quarter, big earnings upgrades, etc. And the stock did move up very substantially. We'll be joined by the management a little later. Margins are down a little bit, 30 basis points quarter on quarter. Otherwise, AUM growth, etc. across the board, across segments is pretty healthy. It's slightly lower again. It's the best performing financial stock YTD. It is also, of course, perhaps the most expensive NBFC after Bajaj Finance, of course, but pretty close to it. It's closed the gap quite a bit. So that's the management chat coming up at 9:40. But for now, let's keep it with the markets. Nilesh Shah is Managing Director and Chief Executive Officer at Envision Capital. He's joining us right now, right here in our studios. Nilesh, thanks for dropping by. Great to have you with us here.
Thank you. Thank you, Prashant.
How are you feeling, Nilesh, about the market? And last time I think we spoke, you talk to us about one area which you're very bullish on, which is home improvement. And you continue to remain bullish on that space. We got lots of numbers recently from that space. I don't know if you count, say, things like Polycab, etc. as part of it. You own it. Just wanted your thoughts on that space now.
Yeah, absolutely, Prashant. I think real estate is probably one of those few spaces which is really coming out of a very, very long slumber. We think the entire residential property market currently is booming. Home improvement is booming. I think demand for mortgage loans, I think, is again very, very strong. And the kind of numbers that we've seen so far, the quarterly earnings, I think has been fantastic. I think just about a fortnight back, JLL came out with a report which said that sales of homes are up 21% year to date from Jan to June, and probably home sales are at a 15-year high. And that's translating to strong demand. Along with that, of course, there's some moderation in terms of raw material costs, input costs for many of them. But otherwise, I think strong demand, strong revenues, strong margins, strong earnings. I think it's a great space to be in.
Specifically, if you want to name names, that'll be fantastic. What do you like?
Yeah,
now?
so I think we own a combination of names there. On the home improvement side, we've been owning Polycab now for maybe 3 years or so. And that's been a great ride so far. They continue to be delivering, gaining market share, growing volumes, managing margins really well, getting into adjacencies. I think that's been a great story so far. One of our most recent additions was Stylem about 4 or 5 months back that makes laminates. Largely focused on exports market, but now trying to kind of make some headway in the domestic market. We own both of these names. On the mortgage finance side, we've been owning it through Home First. That's been like kind of an incredible growth story so far, growing at 30%. And managing spreads and yields and NIMs really well, and managing the asset quality as well. So I think that's been a great place. And another position we've been owning for a very long time now is Kolte Patil, focused on Pune, Bangalore. These have been the big hubs in terms of demand for mid-income housing. So it's been a combination, the way we've really been positioning ourselves and participating in this great story. And we just think that it's still kind of early days. The journey has just begun.
Okay. Manish, hi. Morning. You're joining
Hi,
us on a very interesting morning when there's a sea of red across Asia. All markets are down 2%. Relatively, actually, we're much better off. I mean, India is down only 0.5%, considering the kind of cues that we had. What's the thought on the overall setup now? 19 times, you've seen bulk of the earnings. There's been massive liquidity so far, at least. But I'll tell you why I'm asking this question, because there's some murmur, some thought about the China re-entry trade again, because there's stimulus over there. Now you have these dislocations, the BOJ perhaps trying to loosen its control on the yield curve. You have a downgrade on the US coming in. Slightly big events which perhaps weren't baked in. What's your thought as we look at the rest of the year?
Well, given the kind of advances that we've seen in the market over the last maybe a quarter or two, and the kind of re-rating that we've seen, partly, of course, it got backed up by strong earnings growth as well, especially in the mid and the small cap space. But otherwise, overall, with the kind of advances that we've had so far, maybe in the short term, the ride could get a little bumpy. I don't think we are now any more immune to any of the adverse macro developments, especially on the global side. I think it was a very different situation in Q1 of this calendar year when markets were still kind of low, subdued, participation was limited. And I think at that point of time, at the lows, markets are always more immune to negative developments. But I think the kind of advances that we have seen, I don't think in the very short term there's any room for disappointments. Either disappointments on the very macro front or disappointment as far as companies' performances go. And you will see some kind of knee-jerk reactions to any of these developments. But I don't think this in any way alters our medium to long-term growth trajectory. I think that pretty much remains intact. We saw the GST data yesterday.
Yes.
Again, very strong performance. Okay,
crores, yeah.
I think any administration, any government across the globe would pretty much saying, wow, 11% growth in a month like July. And keep in mind that that's not like a busy season for us.
Yeah.
July is like kind of, and we've had challenges of excess monsoons, excess rainfalls. So keeping all that in mind, I think, yes, in the short term, it could be a little bumpy, but I think we should be fine over a more medium to long-term perspective.
Hey, Nilesh, good to have you in the studio, Nilesh.
Hi, Nigel.
I wanted to ask you about this. You spoke about the real estate space. But, not just real estate, but a couple of sectors and segments, since there's a lot of liquidity, a lot of interest in various companies, a lot of promoters are taking money off the table. That's very debatable whether or not they're getting an easy exit. Is the buyer the smarter one? I wanted your comment on that. Yesterday we had DLF, so just fall to 1% odd. But more of the same. I don't have the data, but I think in the last quarter or so, we've seen quite a few promoters take money off the table. What's your view on that?
Yeah, so Nigel, this is the adage that, promoters are the biggest insiders. So you can't beat them at that game.
Yeah.
And obviously,
that's the problem, but I'm worried about that.
So Nigel, yes, in the short term, it does create a bit of an overhang, and it kind of gets you a little apprehensive in terms of what's triggering this. A lot of these promoters, Nigel, are first-generation entrepreneurs. They haven't seen this kind of wealth built up. I think for them, apart from growth of the business, the security of the family or feeling a little bit more stable, I think is as important. Maybe in some cases it is driven by that. I'm not sure if it's entirely driven by that. In some cases it could just be the meteoric valuations, the kind of up moves that they have seen. They've never seen this before in their life.
Yes.
So I probably think it's driven a lot by that. And my view is that, yes, in the short term, it does create an overhang. But I think for well-run businesses over the long term, I think it's pretty much okay. And probably the buyer probably will get a better deal in the long run.
Nilesh, you like another specific company, MapMy India, which has done well over the last couple of quarters. Just tell us about that story and why you like it.
So I think, Prashant, it's a very interesting kind of a business. I mean, I think it's probably one of those very unique deep tech companies out there. I mean, majority of our tech companies are either IT services companies or they're product or SaaS companies. But this is essentially a deep tech company which is focused on mapping solutions, navigation solutions, geospatial solutions, where the use case is very broad-based. It can pretty much play a role in pretty much any sector of the economy that you can think of, be it mobility, automobiles, aerospace, space, defense, urban infrastructure, various development projects. I think it's a very broad-based kind of thing. So I think from a very long-term perspective, obviously it's not going to be for the faint-hearted who are looking at quarter-on-quarter performance, given that they have elevated margins, and growth can be bumpy along the way. So maybe if you're looking for 1, 2, 3, 4 quarter perspective, it may not be the best idea. But I clearly think thematically and directionally, from a very long-term perspective, like say a 5-year plus horizon, I think it's I think a very, very interesting business to ride.
So we're talking individual interesting businesses. I want to get your thoughts on some of the newer listings because they're actually coming in from very interesting spaces. There's IdeaForge, a drone company. There was NetWeb that's into heavy-duty supercomputing, I think, and these listings have been quite phenomenal. Anything that is of that maybe you didn't buy but you found interesting because the valuations are also a question. I mean, the market's really running after anything that's a new idea.
So, Surabhi, that's an interesting thought. I haven't looked at any of these names in any greater detail. I think from a pure thematic perspective, they all look extremely interesting. But here's my take on some of these fresh listings that I think it's best to wait for, a few quarters. We've seen in some of these cases, some of these numbers, margins, they get elevated just before the IPO. And post the IPO, after 1 or 2 quarters, 3 quarters, the managements do present some really great credible reasons as to why margins have tapered off, why growth has tapered off. And that's the time when, if the valuations remain elevated, then the market does essentially kind of give a root shock to the stock price. So I think it's better to kind of really wait for some more execution.
And then
yes, in the process, you may lose out on 1 or 2 opportunities. But I think on the whole, if you kind of take a step back, look at it, see how the medium-term trajectory is, how's the execution, and then take that leap of faith.
Okay, let me ask you about the other side. So that's all new technology. Let me ask about classic old technology, right? We've had this discussion for so long. And it's been astounding. I mean, there's JP Morgan, for instance. They're like the perma bear on technology. And their argument is that this is not about 1 quarter, 2 quarter disappointments here and there in BFSI. I'm just taking their argument, saying that this is basically a reset to the pre-COVID normal. That's what large companies are going through right now. I don't know. Do you agree with that, if at all? How would you look at what's happening in traditional tech?
No, I think that's a perfect hypothesis. I mean, I don't disagree with that at all. I mean, the reality is that our large IT services companies are pretty much doing the routine, mundane things in terms of deploying technology, deploying solutions for the enterprise customers. And that's a segment which will keep growing probably in mid to high single digits in dollar terms. Okay. And so that's where it is. They continue to basically be able to grow profits at a slightly higher pace with better execution, better efficiencies, better productivity, and of course taking a dose of automation as well out there. That's where, and on top of that, if you have the currency depreciating, that's the big arbitrage that they have within themselves. So these are the 3 factors. But the bottom line is that I think margins have peaked given the kind of COVID situation was there. I'm not too sure if the currency has too much of room to depreciate from here. So you are now back to essentially volume-led or revenue-led growth, which is going to be mid-single digit. That's been the story. I mean, even if you look at any of the large IT services companies over the last 10 years, I think the growth rate, even in rupee terms on the revenues, has probably been just 10-12%. It's nothing, I mean, over a very long period of time. So I think that's going to be the situation. So you're better off buying these kind of stocks at maybe the lower end of the historical range in which they have traded in terms of P multiples. That would be a good time. Get in there, do your arbitrage, and wait for a great time again where sentiment turns back. There's a new theme. Maybe AI is going to be the big theme a year, 2 years later. That's probably the time when you could probably look at exiting. But having said that, there will still be opportunities in mid-cap IT, tier 2 IT, where there are individual companies addressing niches, where they're able to grow in strong double digit. So maybe that's probably the segment to really watch out for.
By the way, Surabhi, Perma Bear is a pretty serious acquisition too.
Well, I mean, they present a thesis with a lot of conviction. Maybe not Perma, but at least for the time, not Perma, a present bear. Let's just say that.
All right, Nilesh, thanks so much for coming down to the studio. Good to have a chat with you as always. Looking forward.
Thank you, Nigel. Thank you.
Chatting up with you, Ravi.
Thanks, Prashant.
Well, time to move on then. Let's focus on a company that delivered a very strong set of numbers, Bikaji Foods. In Q1, they looked quite good. Revenues, profitability, both of them surged. Margins as well expanded, aided by a decline in palm oil prices. Mr. Rishabh Jain, the Chief Financial Officer at Bikaji Food, joins us on the show. Hi, Rishabh. Good morning. Thanks so much for joining in. Well, give us a sense about the Q1 numbers. What were the price cuts and what was the basic volume growth that we saw for the first quarter itself?
So we've done a price cut in early last quarter around March end. So the price cut was close to 2.5%. Despite that, we had done a strong volume growth. Like we had done a volume growth close to 15.5%. Value growth is also largely the same. So this year is largely more of volume-driven growth rather than value-driven growth, which we've seen in last 5-6 years. So and one thing that we've done a highest volume growth in last 5-6 years. We will see a CAGR of last 5-6 years. We've done a volume growth of close to 13-14%. This quarter we've done a close to 15.5% volume growth.
Okay, all right. We also have with us Mr. Manoj Verma, the Chief Operating Officer, who joins us on the show. Good morning, Manoj. Thanks so much for joining in. Well, gentlemen, what about the revenue as well as the EBITDA margin guidance that you all given earlier? For the year, you all were looking at close to around 20% volume growth, gross margins expanding by close to around 150 basis points. But your margins are looking better in the first quarter in comparison to the double digits that you all guided for. What's the outlook on all these three parameters?
So if we look at in terms of bottom line EBITDA margin, so we are ahead of what we said. So done extremely well. In terms of growth also, so volume growths are more or less, beyond what we expected or what we spoke about. Good thing is that, if volume is growing, so which means category is growing, value is not a very long-lived kind of a growth. And this time, if you look at, as Rishabh just spoke about, that our value and volume growth are line in line. So that's what, this is what we expected, and we are very much in line what we thought. In fact, if we look at this quarter, can be divided into two halves. So first half went extremely well. Latter half was in terms of, some pre-monsoons, very heavy monsoons. I mean, it could have been slightly better, but still, we delivered what we planned for.
Got it. Gentlemen, good morning. Prashant here. Rishabh, could you tell us what was capacity utilization in the quarter? I remember, at the time of the IPO when we had spoken sometime back now, you'd said that with the current capacity, the peak revenue potential would be about, 4,500 crores or so. At the end of Q1, what was capacity utilization?
So it's close to 40-41% type of utilization. It's depending on category. Like in ethnic snacks category, we are using close to 47-48% type of utilization. And in sweets, popper, it's a little lower because it's largely a seasonal based business. But yeah, at average level, it's around 40-41%. And also, our Patna CMU plant has started in end of first quarter. So that was also added in the capacity.
40 years. So, Rishabh, you said 41% is your utilization level right now, correct?
Right.
I believe there's also a capex plan that is underway or that will get underway this year. Can you tell us about that? Because 41% seems like a pretty low utilization level. You're also doing capex. So how will those numbers look, say, by the end of the year?
Yeah, so by end of the year, we'll be having the same utilization, like around 43-44% type of utilization. That's what end of this year. So largely we have done capex ahead of time. So we have a capex of next 3-4 years, what we have done. Also, we have got PLI scheme of close to 261 crore rupees subsidy from government, for which we committed some investments, which will close by the end of this year. So that's how we will take some capex, and we are in line with all the capex plan and capex plan accordingly.
No, on that PLI, how much have you received? 260 crores was the commitment from the government. How much have you got? How much more do you expect in this fiscal?
So we have received first tranche of FY22 in March. This close to 20 crore rupees we have received, and this year, so we'll file all the applications by end of this month, and we are hopeful that we'll receive another tranche of close to 32 crore rupees in this year.
Okay, all right. What about your market share from your core markets? I think Rajasthan, Assam as well as Bihar, they are your core markets. Have you gained market share? Are you outbeating the industry growth, and what does it stand at?
States, we have grown market share. Our growths are ahead of the category growth. and we have grown to the extent of 200 basis points in certain states.
Okay, so what does it stand at now?
So if we look at in terms of Assam has moved up in Indian ethnic snacks to about 58% market share. Rajasthan has moved up to 47.5%, and so is Bihar. Bihar has marginally moved up, but yes, there's a 40 basis point movement upwards.
Mr. Verma, if I look at EBITDA margins for the company, they have been in the range of anywhere between 9% to about, I think, 11% on the upside last 3-4 years. So is that the band? Is that, you think, the maximum you can go to 11%? I don't know if you'll be there this year or not, or do you have levers, or maybe a change in product mix where you could go above the 11% zone as well?
So if you look at this quarter, we have posted about 13.6% EBITDA margin. So we moved up that level. And what I would say, there are two things which attributes to this. One is that, during last year, same quarter, the inflation was on the peak, right? So one, that the prices have softened down. More importantly, there's a lot of, efficiencies which our company has built in during this tough times. And that's also helping, us taking it northwards. That's where it is.
No, so that's what I wanted to know. Yes, you are at 13.6 in Q1. Can you be at, say, 13% for the whole year as well? Are you confident of that?
Should be, yes.
Okay. All right. Okay, gentlemen, thank you very much for joining in. Good chatting with you. Thank you for... okay. Well, that is BKG Foods. Just to go back on the market for a bit. Okay, it is 100. Thank you for... okay. Well, that is BKG Foods. Just to go back on the market for a bit. Okay, it is 100-point decline now. Full 100 points. 19,633 is where we are at. And if I talk about the major movers and shakers on the downside, it's the same list. A lot of weakness on metal stocks. A lot of weakness on a lot of the IT names as well. There's no support from IT coming anywhere, or ITC for that matter. And actually, there's hardly any firefighting. Maruti is on the upside, about 0.7% for now.
I think we should keep an eye out on Hero MotoCorp as well. Yesterday, the stock got pulled back, but now we understand that the ED searches at the Hero Motors offices as well as residents of Pawan Munjal are over. Yesterday, the stock had pulled back. Now we're seeing a bit of a recovery from the low point of the day. So that's source-based information that's coming in there. Unlikely to have a big impact on the operational performance of yesterday. Because of the sentimental hit, the stock did pull back, I think close to around 3-4% approximately. Now we're seeing some bit of recovery from the low point of the day, though it's still down close to around 1.5% or thereabouts, guys.
Okay, I have some more stocks from the mid-cap screen. Let's talk about these. Now, some of the high movers and shakers. Remember HBL Power Systems, which has been on a bit of a tear. That stock is down about 2-2.5% this morning. Sula, we have pointed out earlier. Reddington is an earnings miss. So this decline is pretty widespread, even in the mid-cap market, you'd have to say. Watch out for Z. That's one stock that we haven't spoken of. Last time I checked, Z was slightly negative. Let's turn to the flat line. The reason the spotlight is on Z is that IDBI Bank has gone to the NCLAT now, challenging what's been going on. IDBI Bank is one of the creditors. They had moved against Z, asking for the invocation of corporate insolvency because of non-payment of dues. Z went to NCLT. Now IDBI Bank has gone to NCLAT. So one more twist in the legal battle around Z. Stock for the time being is flat.
Absolutely. Just a couple other names here. Indiabulls Housing, right? I mean, it's coming up right at the top of the volume list. And it's got a big move today. I mean, I think 6 or 7%. The name will come up on your screen. And that is at, 151 or so, Indiabulls Housing. There you go, on your screen. KEC is another one, which I think is up 8%. So that's a big one, on large volumes, mind you. And I just want to look at one mover from yesterday, Dilip Buildcon. That was up, limit up 20%, circuit up 20%. It's basically come up from 170-ish levels a couple of months back to 300 plus. And it was on Nimesh's chatter list as well. This morning it's starting slightly weaker, but flat 1%, 1.25% lower or so in terms of trade. What else? Star Cements is up about 5%. We've got DB Corp. DB Corp is up 10%, by the way. Stocks at about 250. So this is, by the way, market breadth. Even as the index is doing what it is doing, market breadth is ahead by a whisker. Advances are still ahead of declines. by a small whisker at this stage of the open. All right, I think we'll get to more stocks, etc. in just a bit from now. But let's focus on the numbers from Chola Investment. Now, Chola Investment, of course, has been the darling for stock markets for such a long time. It perhaps is the best performing financial stock in this year so far. It's also, of course, valuation-wise, moved up quite a bit, pretty close to where Bajaj Finance trades. Numbers for the first quarter on the AUM side has been pretty strong. I think some 40% growth. But net interest margins have come weaker. I mean, they're actually down on a quarter-on-quarter basis. Arul Selvan is President and Chief Financial Officer at Cholamandalam Investment and Finance Company. Thank you very much, Mr. Selvan. Appreciate you joining us here on CNBC. Prashant this side. Congratulations. Overall, AUM trends are healthy across various segments of businesses. But let me start with that 30-35 basis point compression quarter-on-quarter on net interest margins. What was behind it, and what are we seeing so far in Q2?
As we had explained even in the past, the large part of our book is vehicle finance, which is like a fixed rate book. So here what happens is it takes time for the new book to become a larger part with a higher marginal yield coming into play. So till that time, there will be some NIM compressions. On the other side, the cost of funds had increased a bit. So both put together has resulted in this NIM compression. But I am confident that this is where we are seeing the peak of the cost of funds. So from here, we should have some improvements on the NIM. But for any further actions by either on the Fed side or on the RBI side. But I think going by the trends, we are confident that the cost of funds would hold up and NIMs will improve.
So you're saying that the Q2 onwards, we will see if things stay as they are on the cost of fund side.
Correct.
NIMs will improve from here.
Yes, we are seeing the peak of the cost of funds, and we have done a certain amount of securitizations, etc. during this quarter, which would also help us to bring the cost of fund down in the coming quarters. Another reason is we also did a large amount of Tier 2 during this quarter, which also resulted in a slightly higher cost of funds. But I think these are normal routines, so I don't want to say these as any reasons for the increase, but yields will improve and cost of funds would hold where they are. So between the two, the NIMs will improve.
Okay, so you're expecting better NIMs as we go down the year. Sir, let's talk about business growth, which has been strong, both if I look at disbursals, also at the AUM level. AUM growth of about 8%, just under 8% quarter-on-quarter. That's really strong. I think most of your segments are firing, but I want to understand this new business segment. What all classifies as new business? Because here, both dispersals as well as the AUM itself has shown a huge growth. What's powering this?
So we brought into play three new businesses. One is the SME segment. Actually, we've been handling that segment for quite some time, but within the Murugappa ecosystem. But we moved it outside the group also to having experienced it within the group for more than 3 years. Over the last 18 months, we have been scaling up this business, which is to address the needs of the SME segment, which is more for their working capital as well as for their equipment purchases, etc. The second part of the new business is the consumer and small enterprise loans, where we do loans for business purposes as well as to some amount of personal requirements of self-employed non-professionals, which is mostly unsecured. So there we have a good growth coming that we do either by partnering with fintech companies or on our own. Both we are having both models running, where the in-house model has a larger proportion and the fintech partnership is a smaller proportion right now. The third one is what we call as the secured business loans, where we have the loans given to very small vendors who will be wanting loans for their shop opening or for the business requirements again. Against here, this is a secured loan with the property, underlying property as a security, but for a small ticket, but a high yield loan. So this segment would be, a large part of this segment would be new to credit, while the CSEL, which is the consumer and small enterprise loans, would be 99%, credit tested.
And you're expecting this kind of growth to continue in these segments, SME, the small retailers, as you mentioned. So, I mean, this will continue to be such a big driver?
See, the growth you are seeing as percentage seems to be large because the base is small and the market is very wide, and you need to test these products with a larger proportion of samples. So that's what we are doing. But we are seeing good results, so we are confident that these will have good growth legs for us in the days to come.
All right. Hi, good morning, Mr. Selvan. Besides your operational performance, the other aspect that the street took note of was the board has approved fundraising via equity. That amounts to around 4,000 crores. My question to you is, what's the need to raise funds when your CRAR is so strong? And also give us a couple of details. By when will you need to do this fundraise? And will it be in tranches or will it be in one go? Please give us more clarity.
See, we are seeing good growth. Again, if you go back to our earlier interactions, we have said that if we are growing in the range of around 25% and returning a pre-tax ROTA of 3.5% levels, it is adequate to do a sort of a self-financing model on the car. But when we are seeing growth happening slightly at a larger pace, and for the intervening period, because of expenses, because of shorter trends of the NIM compressions we spoke about, we need to adequately protect the car, and that's where we got this clearance from board to raise 4,000 crores. Now, the 4,000 crores would come by way of partly equity and partly a convertible instrument. We will be starting to discuss with bankers, and we will come with more clearer mix of this as well as the process of this, and the timing of it in the next few weeks. So then we will be more able to clearly say what it is. Just got approved yesterday, and the board has given a internal committee, the flexibility to decide on this.
So before next results, will you raise this money?
Yes, if the market is good, we will certainly.
The market is good, sir. That's why I'm asking you.
Yes, see, the investor appetite and our expectations on pricing, etc., should match. That's the key.
Okay, so just clarifying one thing, and this is just some talk doing the rounds in the analyst community. Your provisions went up quite dramatically. I think there's a 24-25% year-on-year increase, and it's a massive increase quarter-on-quarter. People are trying to understand if you're trying to raise more money because you will have to build more provision buffers. And I go back to the new business when I ask that question, because the sense is that I think the NPA levels in that business are much higher than the overall average. Is it true that the new business NPAs are as high as, say, 5%, whereas otherwise you're at 4.3%?
No, that's wrong. See, I'll explain to you. First of all, comparing year on year, we are comparing at that point in time without the management overlay, I presume. When we came into March, every March we changed the PD LGDs of every businesses. During this year, when we changed, it had a slightly higher PD LGD impact because of the COVID years coming into play. So that has resulted in the need for higher provisioning as a norm. The second part is, as you see, when we are growing 40%, we need to create certain standard asset provisioning itself. That would by itself would be a larger part of provision that is being created. Between these two, we have a higher provisioning. As a matter of fact, we have been always questioned the other way, that our provision coverage seems to be lower than many others in the industry. So while we tried to bring it up to speed on that, now we are again being asked on the other side. So I think with the 40 to 45% levels of provision coverage is where we will be comfortable with them.
But are the NPAs higher in the new business, sir, compared to the other segments like home loan, etc.?
One part of the new business thing you would see is For the new businesses, we get reimbursements by way of FLDG. Now that FLDG is not adjusted in the loan loss, but it is shown as income on the income line, and the loan loss gets accounted as a full number, as if it has been incurred as a loss. So this may be the reason why there is a presumption that the new business is showing, but around 35 crores of FLDG which we received towards the new businesses has been shown as income in the income line. This is as per the Ind AS accounting norm.
Yeah,
sorry.
I got that. Mr. Selvan, slightly a top-down question on asset quality, just to kind of press on that point. You know, not just for you, but other companies as well, how this credit cycle plays out with respect to asset quality, we will not know till much later, right? Because, I mean, that's the nature of lending as a business. Are you confident that asset quality and lending standards, etc., will be maintained at the very high levels that you've maintained them at? And I guess I'm also asking this in the context of you know, the challenge. I don't know how much of a challenge do you perceive this, but pressure from investors, you know, media, for example. We ask you every quarter what will be AUM growth and what will be NIMs, etc. I mean, so will you be able to kind of maintain those standards at very high levels and not loosen them at any point? I mean, just to talk to us about how you're doing that.
See, Chola's predominant focus has always been collection. Actually, with regard to every business, we have created separate verticals, right from sourcing, collection, credit and collection. So they are individual, so there's no mix-up in between the businesses with regard to people who are handling it. The second part is our focus with regard to the new businesses has been to make sure that there is no major losses in this, and we have ensuring it, and the past trend again shows you that we had been good in collection, and we have kept our the stage 3 or the gross NPA numbers in check in most part of our results. Only the aberration would be the COVID period, but for it I think the norms have been well maintained, and we are back to the pre-COVID levels with regard to stage 3 as well as on the gross NPA numbers. As a matter of fact, gross NPA numbers have come down, which is actually a positive indicator, because that means the stage 2 has come down, which is also, if you see the stage 2 numbers, the stage 2 has come down, which means the fresh flow in is reduced. The new businesses will have slightly higher NPAs, because their tendency is to have a higher NPAs, but we are keeping them in check, we are watching them closely, but I don't see that as a showstopper in the future. Actually, they are performing very well, and we are consciously and conservatively working on these new businesses.
Okay, got that. Thank you very much for joining in, sir, and clarifying some of those points and giving us a view on the business. Appreciate you being with us on the show today. Well, that's Chola Investment, and the stock has sold off down about 4% right now for the market. By the way, we took support exactly at the 20 DMA. Managed to hold it for now. Let's see. There's a long day that lies ahead. Quick break on that note. We'll come back on the other side and get chatting with Saket Jindal, Managing Director at Maharashtra Seamless.
Welcome back. You're tuned into Corporate Radar here on CNBC-TV18. Well, let's get straight to our next management. Maharashtra Seamless, well, they reported a steady set of numbers in the first quarter. The company managed to expand its margins, but the revenue contracted by around 8% on a year-on-year basis. Do note, the company was impacted due to a shutdown in one of its seamless pipe manufacturing mills at Telangana. Mr. Saket Jindal, the Managing Director of the company, joins us on the show. Hi, Mr. Jindal. Good morning. Thanks so much for joining in. Well, the stock has been a big outperformer, but yesterday did see some profit taking. Now, a couple of points the street was looking at. One is the order book has come down by close to 300 crores because you're executing some of those order books. My question to you is, are you seeing some pressure, some kind of slowdown? since the US rig counts, they are on a decline. So are you seeing some demand pressures?
That's right. In the US and Canada, there has been a decline in the demand because when inventory stockpile, and it'll take a month or so to pick up because the inventory is already in stock, basically.
Okay. All right. So as of now, demand is a little bit subdued, right?
Yeah, that's right.
Okay. What about your exports? What was it as a percentage of sales in the past quarter? And was there a decline out there as well for reasons that you just mentioned?
Yeah, the decline is mainly in the export because of this reason I had mentioned. And it should pick up soon, I think by next month. And our export is mainly to USA and Canada. So
yeah. So exports as a percentage of this 1,200 crore revenue, sir, was how much?
I would say around 20%.
20%. And the decline was how much?
Say earlier it used to be 30 to 20.
Okay. All right.
Okay, so that's, of course, that explains what happened in the first quarter, a bit of a wobbly start to the year. But Mr. Jindal, tell us about the outlook, the full year outlook. Let's talk volumes first. How much do you think you will target for the year as a whole?
Right, so production volumes, if I see, then last year it was, for the financial year, 430,000 seamless. And we should have a growth rate of at least 15 to 20%.
Okay. 15 to 20% growth rate you're maintaining, right?
Right.
Okay. All right. What about the EBITDA per ton? For both your seamless as well as your ERW pipes. I'm looking at it. In the past quarter, the seamless division, it did well. I think maybe a high amount of contribution from ONGC orders. So what is the number we should work with for both these two segments? EBITDA per ton, sustainable number on the seamless side,
right,
and the ERW per ton.
So EBITDA per ton, if we see, then if I see the numbers correctly, then do you want to see it as a percentage or per ton?
Absolute number, sir. Just to give a reference point which should come up. Yeah, it's around 22,700 for the past quarter on the seamless side, and on ERW it's a little less than 5,000 rupees. So what's the sustainable number?
Right. So on ERW we can increase to at least 7,000 to 8,000.
Okay.
And in seamless we can maintain 22,000 or thereabouts. I think we can maintain in seamless.
Okay. All right. One just quick question with regard to the domestic industry. China has unlocked and they've reopened. The fear is, will they export more amount of what they're producing? So I want to ask you, is cylinder pipes imports coming into India? Is it hurting your business? Have you seen an increase out there, or is it pretty much manageable?
I think there is some pipes which are coming from China, which is in the non-PSU sector, and it is not so significant. But we would like the government to check that through import duties. And otherwise, we are in the oil sector and PSUs, we are still okay.
Is there a duty that is currently in place to protect you?
Yeah, there is a policy for which government gives more preference to domestic industry, and thereby we are protected against the Chinese imports.
But as of now, exports is not a big problem. Imports is not a big problem, according to you.
Imports in non-government requirements, there is some imports happening.
Okay.
Okay. All right, Mr. Jindal, we will leave it on that note for today. Thank you very much for joining in and giving us an outlook on the business. That's Maharashtra Seamless. With that, back to the market, which is trying very hard to hold on to this 20 DMA level. We have Mitesh back with us. Mitesh, so what do you make of it? 100 points down. Buyers still not in sight. What's the advice?
Morning again, Surabhi. I think, there's some negative pressure with the gap down today. And I think once we start heading towards 19,580, 570 zone, which is where the market had bottomed out on Friday on an intraday hourly closing basis, I think there's a risk of us breaking below that, and the correction could extend to about 19,450 odd level. So I think this will be slightly mildly, downward bias kind of a market for the next 1-2 sessions, and we should hit our lower support areas. So I would be taking a slightly short bias. I think on the Nifty itself, we have bought into some put options. If it gets closer to about 19,675, 19,690, even shorting in futures with a 40-point stop loss is advisable. And on the stock side also now looking at more of shorting ideas. So I have a sell on L&T, which I would recommend selling with the stop at about levels of 26.65 for targets of 25.75. And Bosch is the other one which is breaking down. So that's a sell. Keep a stop at about 18,900 and look for targets below 18,000.
All right. Thanks very much, Mitesh. Appreciate you joining in with that. And good speaking with you. We'll take a quick commercial break here. We are back. Markets it's pretty much the same kind of picture. Down and out, at least on headline indices for now. Market breadth, though, overall market breadth is still positive by a small number, about 100 odd stocks, more in favor of advances compared to losers. We'll be joined by the management of PVR INOX to discuss their quarterly performance, but more importantly, the second quarter is panning out like. The company sounded very, very confident in the conference call. Stay with us.
Welcome back. PVR Inox is the next company on our radar. Q1 numbers have actually come in better than estimates. Losses are still there, but they have reduced, and the losses are lesser than what the street was anticipating. Margins have actually improved by 400 basis points. We have PVR Inox CMD Ajay Bijli and CFO Nitin Sood joining in for this chat. Gentlemen, good morning. Thank you very much for being with us. Ajay, I'm just going back to an old interview. I think it was an interview that you did at some point in time during the pandemic, where you very beautifully put things in a poetic way, saying that basically, when the going gets tough, the tough gets going. And I think this story is testament to that, right? And the market's taking note of it. But you tell us, the numbers that we're seeing right now, are they a function, is this improvement a function of your operating sort of leverages? Or is this a function of the fact that maybe content is going to come back in a big way? Yes, we are in the Barbenheimer era, and that will tell us a lot about the second quarter. But you tell us, because content is ultimately at the heart of it all, right?
Yeah, absolutely. And actually, good morning, first of all, to you. And actually, there is no getting embarrassed with the fact that our business is dependent on content, and which actually reassures me about the business more than anything else. Because since the Lumiere brothers opened cinemas in 125 years ago, content is what makes any cinema work. And in a country like India, where volumes matter a lot, 1,200 films, even last year 300 films came every quarter. I think it's a good place to be. And on the other side, on the demand side, you have consumers who of course got distracted and of course got impacted by COVID. Again, there is no denying the fact that COVID had a big impact on our business. Habits changed, content was being consumed at home, but still the propensity to go out, the will to go out was always there. The content which was getting played was not connecting that much with the consumers, but now that is back. There's a fatigue factor of being at home watching OTT, streaming platforms. That's gone. So all the data points are showing that even smaller movies last quarter, in fact, the quarter that we're talking about just now, Zara Hatke, Kashmir Files, of course, and then some big Hollywood movies like Fast X, Guardians of the Galaxy, all these movies, PS2, they would have probably not done that well earlier, but they did phenomenally well because the data points are showing that people are wanting to come out and they are wanting to consume content on the big screen. And even this month, this has surprised us. I mean, Oppenheimer doing so well, in fact, has only shown the maturity of the Indian audiences, because Barbie all over the world has done much better than Oppenheimer. Yeah. But in India, the audience is pretty cerebral. And they have almost 3 times the collections of Barbie is Oppenheimer. And Rocky and Rani, of course, have done exceedingly well over the weekend. And so I think the mood is a little upbeat. People are coming out.
Ajay, I can tell you, our very own Mr. Prashant Nair is a big contributor. He's watched Oppenheimer not once but twice. There, I'm just placing it on record. You're a huge fan, aren't you, Prashant?
I am. And I think I'll go for the third time. I think 9 hours on one movie, I think that will be the max for me, because it's a 3-hour running time. Gentlemen, good morning. Great to have both of you here as always. Prashant this side. Ajay, I think one statement yesterday on the call, which I think got picked up, and I think you guys said that we will see numbers which we've perhaps never seen in the second quarter. Could you contextualize that specifically? What do you mean? Because you've got Mission Impossible, you've got Oppenheimer, you've got Barbie. So some very big movies. What are the numbers we should expect?
Well, I can just tell you the lineup which is there, which is giving us confidence, and the consumer behavior which is giving us confidence. You've got the big weekend of Independence Day, which is always very big for people. Just come out anyway because the mood is there to go out. We've got Gadar 2, which is tracking very well. We've got Oh My God 2, which is tracking very well. Jawan is a big one, and the way the movie is being made with Atlee and Vijay Sethupathi, Nayanthara, it's looking like a movie that will resonate everywhere. We've got Jailer coming, which is a big Rajinikanth movie. We've got Salar coming, which is another Prabhas movie. So I think overall the content lineup is what is giving us confidence, and the consumer behavior, as I said. People, I went to see Oppenheimer, saw Barbie, all these movies. People are coming back to cinemas after a year and a half, and their appetite to go out has really improved. They say, wow, I'm going to come next weekend again. So that habit which had got dislodged about a few months ago, does come back again, which is very heartening to see.
All right. Ajay is clearly sounding quite buoyant. That depicts the mood that we're seeing out there. But Nitin, let's come across to you for a couple of numbers then. The average ticket price for the past quarter was around 245 rupees approximately. I'm noticing prices are going up a little bit. What's the average that we're looking at, for the coming quarter? And also give us a sense on July occupancy. Quite a few, blockbusters out there. So what has that number been?
Yeah, so, ticket price in our business is also a function of the big films. Q1, unfortunately, did not have too many big films. And we're comparing these numbers with, Q1 of last year when we had RRR and KGF 2. So strictly, the 2% occupancy, the ticket price number growth looks low. But you will see a, strong growth in ticket pricing in the coming quarters. We're targeting, anything between, 6 to 8% average ticket price growth for the year. And I think we seem to be on track to get that. On July, I think it's one of, the best ever months that we've seen in the last 12 months. It's with the highest box office collections and, stupendous F&B revenues on back of some of the promotions that we've launched. And that makes the mood quite upbeat for us. And like Ajay said, the content lineup for the rest of the quarter is looking strong. And that's the reason we believe, this should be a bounce back quarter for the exhibition business.
Okay, I know it's very early in the year, but Nitin, since you have some of, a grasp on some of these trends, ad spends, F&B, ticket pricing, can you try and crystal ball gaze for us and give us some sense on FY24 revenues? Content is better, then you have all these other kickers coming in as well. How much growth this year?
Yeah, I think tough to put a revenue number because a lot of it is linked to, our overall box office. But, it could land up anywhere between 6,000 to 7,000 crores, depending upon where the box office plays out in Q3 and Q4. And we are quite
margins?
Confident. Margins, again, like I said, it's an operating leverage business. So high operating leverage in the business impacts the margin. So I wouldn't like to put any number to it for the time being. But I think as we get to the second half of the year, we'll be more confident to, put a number on the operating margins for the year.
Nitin, on ballpark, what have been the collections in July?
July has been quite a good month. Like I said, it's in the last.
If you can give us a number, Nitin. Sorry, we're just pushing because
I think India overall box office, the numbers are not out, but overall India numbers in terms of box office for the month for all films put together seems to have, touched 1,000 crore number, which is a very, very heartening number and could be, the highest number in the last 12 months.
Okay. All right, gentlemen. Would have loved to go on, but I think that's the time we have for now. Thank you very much. And that's a big headline. 7,000 crores of revenue. That would be easy doubler, I think, over last year. Thank you for joining in and good luck with the rest of the year. We do have to quickly take a break because there's lots more coming up on the other side. We'll have Lata joining in with our special segment, It's the Economy. Today, she chats with Pranjal Bhandari of HSBC as well as Abhishek Upadhyay of ICICI Securities Primary Dealership to talk about the rising food inflation scenario in India.